Entirely clear. Jason Bordoff is with me. He served as energy advisor to President Obama, now the founding director of Columbia University's Center on Global Energy Policy. Good to hear me. Good to be with you, sir. Hopefully you can hear me clearly. So yes. This is a situation where we have multiple producers, global producers. The US, though, can't switch on and off by government fiat. It doesn't work the same way as everybody else. So what happens now when West Texas is as low as it is?
Well, this is what happens, right? As you said, President Trump, it is unusual to see the U.S. want higher rather than lower oil prices, but that's the situation we're in as the largest producer. And President Trump pushed and prodded Saudi and Russia and others to cut production and promised that the U.S. would deliver market-driven cuts. This is how market-driven cuts work. You need to see the price of oil collapse to the point where you actually incentivize shut-ins. And that's what's happening as we see storage limits breached in Cushing, negative prices, and obviously the June contract has sold off as well. So this is the kind of market incentives that you need to deliver the production cuts in the U.S., and we're going to see pretty big production cuts.
Now, the production cuts, we've been talking a lot about why you can't just switch it off. I mean, let's face it, you start the pump up and why can't you switch it off? We understand now that that's not quite so easy. So essentially, once they've started production cuts, this becomes an extremely difficult capex issue if you want to get that well started again.
Yeah, it can be particularly damaging to wells to try to shut them off. Now, shale is a little bit unusual because we think of shale as short cycle. Shale ramps up more quickly and it ramps down more quickly, but it doesn't happen in a matter of weeks. It's not spare capacity of the kind that Saudi Arabia holds. The way shale works is it has a pretty steep decline rate, and if you lay down your rigs and you stop new drilling, you'll see over a period of 6 to 9 months shale production decline. But now we have a month or two in which we need shale production to come off pretty significantly, and that's what's causing these significant bottlenecks that are leading to very low, even negative prices that are incentivizing people to really shut off wells that are still operating, and that is difficult and costly, and it can cause some damage to the wells.
And in terms of companies going out of business, not just oil producers, but the entire eco-structure, the oil supply companies, what do you think happens there?
Well, we're going to see a lot of pain ripple through the oil patch, oil companies and workers. But as you said, also all the indirect companies, all the jobs, the restaurants, the service workers. We saw that 50,000 jobs lost in drilling in March. That is going to continue to rise. You know, normally you would expect that low prices would also provide some boost to the economy because consumers would save money when they fill up at the pump. The problem is no one's filling up at the pump right now because we're on lockdown. So a lot of the pain in the oil patch will be felt by workers there, and it's now sort of rippling out to the broader macro economy, particularly because the U.S. was on the cusp of becoming a net oil exporter. It would have been one this year for the first time before this all happened.
Right. Jason, there's no obviously easy solution, otherwise we'd have found it and people would be doing it. But give us guidance as to how you think this plays out. When we've got West Texas, it looks as though, I mean, if things carry on, the June contract, which is at $10, will go negative too, with every possibility. So what does happen next, in your view?
Well, I think what has been happening continues to happen, and there's going to be, more pain for the oil patch before there's any relief, maybe another 4 to 6 weeks of these kind of very low prices that need to incentivize shut-ins, and that is going to be what pulls U.S. supply off the market, maybe something like 1.5 to 2 million barrels a day, but along with production declines elsewhere and the promised OPEC Plus government-mandated production cuts start to help us avoid hitting some of these storage limits. But it depends how quickly there's a recovery in oil demand, whether we can, and as John Jefterios just said a minute ago, whether the government allows that to happen, or whether, because the pain is so intense, we actually see the Trump administration step in to try to provide some relief and prevent those market-driven supply cuts from happening.
Good to see you, Jason. Thank you. I promise you, we'll call on you again when we need to understand what's happening. Thank you, sir, making good common sense